have a dog that looks like that. It's a rat terrier.
Oh, bet he's adorable.
Yeah. Complete nut. We got it from a rescue place, and it was really calm, just sitting there. Okay, that looks like it. Got home. So it's sort of like this. They have they start out with your expenses, and then they go into detail on the revenues.
Mm-hmm.
Over here, they kind of give the net. You know what? So expenses minus revenue, and usually for the government ones, these are going to be negative usually. This is usually a negative number. For the business ones, this is usually a positive number. You know, businesses can cover the expenses, whereas the regular government a lot of times can't. And then underneath, they say, okay, well, these are usually negative in total. So then they have general revenues. They're usually property taxes. So these are expenses that are specific to a certain fund. These are revenues that are specific. And so for each fund, there'll be a net balance. This is for the government ones, it's usually negative. And then down here it says, okay, well, we still have other money though, you know, other than the regular revenue. So other than parking tickets and all that kind of stuff, we still have these property taxes. And so this is what we're doing. This will give us our fund balance. So it's kind of a weird document that it goes across and then it goes down. And these are usually fairly small amounts, not small amounts, but a small area. There's usually 5 or 6 numbers in here. Whereas
these are for the statement of activities. So this is per activity, and then
each
coming down to the balance. Yeah.
Each activity will give their balance, which is usually negative. They usually didn't make profit. The business ones a lot of times will make profits, but the government ones will be negative, and usually overall this is negative. But not to worry, because then they have down here. So it's sort of weird in that it shows, you know, these are, you know, the expenses are just one number. You know, it's just one number, and then they say, okay, you know, how do we cover it? Well, here we got these revenues, we got the net, and then we also have these general revenue. So it's very detailed about how to cover this one number, you know, for whatever it is. So it's kind of a strange document. And then, it goes across and then goes down. So when we look at this, let's see. You know, this is going across the page. So here's a program revenue. So these are specific to whatever the programs are, and because this is on 2 pages, you have to look up here. It's such a wacky document that it doesn't really fit on one page. And so down here, they say, okay, here is the net position. So the government activities are negative, which we expect. The business activities are positive. You know, a lot of times that's because they're set up to be positive, like O'Hare. You know, it's, the fees and all that are for. So these are, so this is kind of the way it usually goes. The government stuff is negative. They got to cover 6 billion. Business type, they've actually made profit. This is the overall. And then down here it says, okay, how do we get the money to cover it? You know, and that's how they come up with this down here. And here's the change in position for the last year. I don't know why I thought that wouldn't do that. All right, so this would be sort of like our income.
Right. So
the income for the general government would be negative 854 million, positive for the for-profit business type. Over here, the net of those. And you'll notice that the beginning position on these was pretty ugly to begin with. This is sort of like the retained earnings, like negative retained earnings, and we've been losing money for years. So this is the negative amount. So, you know, we add those together. So this is really, this number right here is really the ending number. And that's what basically people living in Chicago, that's what they're on the hook for.
Wow. So they're saying they're 29 billion, like in the hole, even including all the business expenses. So that ties back to what you said earlier about, what page was it? On page 31, where was it? The 31. Oh, so that's the same as the total net deficiency position. That's what it was.
It should
One
be.
page up. Yeah. One more page. Yes, right there. Yep. Okay.
Not too far. Yep. Yeah, and so, you know, and that's, and by the way, one of the reasons why they made this document, again, this is fairly new document, 25 years or something like that, I don't know. One reason why they made it is because when you only look at the current stuff, you don't actually get a big picture of what is actually owed because there's no long-term liabilities.
Right.
And when you start figuring the long-term liabilities, they start to get huge.
And it's because they can't do, presumably part of the reason is you're saying, so it's the pensions and then they just can't do more business work than they can like pay off pensions and that kind of thing.
Yeah, you know, I mean, you'll notice that you know, there's well, and even let's go down here. You know, even looking at this, I mean, they're not, you know, the business type activities, they're not even covering the losses for the current year. You know what I mean? They're still
right.
Short. And this is after all the taxes and all that kind of, you know, this is after 1.4 billion in property taxes and everything else. They are just not getting it.
Mm-hmm.
So yeah. Well, looks like they did sell some assets here. They sold 79 million.
Wow.
Or I mean, I should say they had a gain on sale.
Mm-hmm.
So yeah, it's a big number.
Yeah.
And I want to see if I can find a note for the pension.
Looks like page 50 has the statement relating to pension trust funds. Oh, I searched pension in my document. It's still counting. 223 and counting.
Yeah, that's a big one. Well, and some of these will be, you know, some of them will probably be the funding of them, you know, how much is funded and all that kind of stuff. Yeah, I guess we need to find it. But if you want to look through that, there, you know, again, these are, you know, it's called comprehensive, and they are. You can see,
yeah,
quite a bit of information in there. The 228. The Illinois one's about twice as big, which, you know, you kind of expect. They do a lot more stuff. So, but yeah, so this is what they in you'll hear this called a CAFR all the time. It's a comprehensive annual financial report, but no one calls it that. They always call it a CAFR.
Right.
So it is fairly extensive to say. Well, it's sort of like a regular thing for a. It's actually more expensive than an annual report. And there are things that they must have in there, you know, that are required and so forth. And it's a pretty extensive document. Not all places need to put one of these out, but usually the larger ones do.
Oh, but maybe small governments don't.
Yeah.
Oh,
you got small government. You know, you got some place that has 3,000 people. They're probably not going to put. They'll put out financial statements that they signed off on. They're probably not going to have a comprehensive report. So,
okay.
Yeah. So that's what you know. I want. Let me see if I can search it. Search.
If you just hit Control F, usually it'll search.
Oh. Again. I may have a crappy. All right. Well, anyway, yeah. So this is. Oh, here's the airport stuff. Let's see what the airport has for.
Oh wow.
Midway's underwater.
Yeah, I didn't expect that. Huh.
have you flown out at Midway lately? It's horrible.
To be fair, no.
It used to be the greatest airport, but when I was auditing, it was a love flight out of Midway because it was like a bus stop. Pull up in the parking lot, walk in 15 minutes to get on your plane. It was in the planes were Southwest planes. You didn't even have a ticket. You just had like a boarding piece of plastic. It handed to you when you got there. And when you went on the plane, you handed it back to them. And,
Wow.
Yeah, you literally be, you could literally be from your car to flying in like half hour. Now it's like 2 hours.
Right.
So anyway, yeah. So that's the that's what I captured. Okay, let's go back to what we were doing before.
Yeah. Chapter 11.
Yeah, general fund.
Yeah.
I guess we didn't have any problems with the.
No.
Okay.
I think we stopped at we finished number 6.
Okay. Okay, number 7. Let's see. Number 7. These are cash receipts, and these are not booked ahead of time because you don't know. Excuse me, you don't know how many people are going to come in for building permits. You know, whatever. How many going to come in to license their dog or whatever it is. Parking tickets and all that kind of stuff. So these are things that generally you record as you receive them. So, and it might be a good idea to keep them separately, although you could also lump them together. But you probably have something that looks like this. So these are going to be for cash. So your cash is going to go up. So 80,000. And as an accountant, I would encourage you whenever you get like a number of things together, not to lump them together.
Right.
Because it's invariably someone comes up and asks you, where's this paid out of? If you put them in all together, here to add these all up, whatever it comes up to, 166,000. If you put that cash in all at once, you're not going to see 80,000 anywhere in cash. You have to dig that back and go through stuff. So it's a lot easier just to do them separately. And that way,
Makes sense.
You can always just point to it and say, there it is. We had a student at Robert Morris University I used to work at, and she did an internship for a not-for-profit. And the not-for-profit was for people that were released from jail, and if you send them back to their old neighborhood, they're going to fall into the same thing they did before. So it was kind of like a halfway house, and it was generally the people they would get them, they'd help them get jobs and all that kind of stuff. And eventually they would leave and hopefully stay on the right path.
Mm-hmm.
So anyway, they had all these. So our intern goes there and they, so this would be the germ one.
Right.
This be the revenue. And again, I encourage people to keep, and the test, if you put these all into one lump sum into cash, I'd be fine with it. But in real life, you want to keep these separate because
right.
You want to be able to trace it. So anyway, so she went there and she met with a guy a couple times and he gave her some invoices to enter or something. And then the guy quits.
Mm-hmm.
And in fact, I guess the guy was on drugs or something, and he all the places to work. And then he, so anyway, we went there, and so they asked me if I'd go there because I taught it. I'm like, sure, I go there. There's 1 million accounts. They had 5 or 6 people that came through, and each one used their own accounts. And so they had dozens of accounts that were all the same.
Oh my God.
And so we went through, and it was kind of funny. We took like basically like 6 hours. We went through and just started consolidating and just eliminating all these accounts, because you pull up an account screen and it was
right.
It was like a phone book, and you go, oh man. So anyway, so we went through then we did the whole thing, but we finally got the bank reconciliation to balance, and I've never been so happy in my life because it was such a mess.
Oh my gosh.
When I first looked at it, I'm like, oh man, this is good enough. Coming from auditing, like this is big weeks.
Mm-hmm.
Okay. So September 3rd, a purchase order is placed for 2 pickup trucks. Okay, so purchase order. The estimated costs are $41,000, $53,000. On October 4th, the pickup truck is received at a cost of blah, blah, blah. And the invoice is paid on November 1st. Okay.
Okay.
So normally, when you place a purchase order, there is no journal entry.
Right.
Because no one has done anything yet. No one sent you anything. You don't owe them any money. There actually has been no transaction. So the purchase order usually don't do anything. Now in governmental accounting, we do. When we make a purchase order, we encumber the money. Let's see. So we have encumbrances. $41.53 is what, 94?
Yeah, 94.
Okay, so we have encumbrances for 94,000. And we'll have encumbrances outstanding. So this is us putting our hand on the money and telling people, look, you can't spend this 94,000. It's already spent.
Right.
So we put our hand on the money, and again, this is no transactions actually happen yet. And these are budget accounts. They are not. They don't go on any financial statements. You won't find this on any of the financial statements. I mean, they might be in the notes or something, but and no financial statements going to have those. These are the budget accounts.
Mm-hmm.
And they're simply there to let people know that you can't spend it. Okay, now we get the pickup truck. The pickup truck comes in on October 8th.
Mhm.
Excuse me. So at that point, we do owe somebody. Now we got a truck. Okay, so the first thing we have to do is take our hands off of the money that we set aside for this truck. Okay, so this is truck 892. So this is the one that came in. Okay, so we have to take that off the books. We just reverse this out.
Right.
Now, it sounds completely silly, but that's what we do. So we gotta take off 53,000. So we take it off of whatever we put it on the books at. Okay, so this is the total. And we haven't paid it yet. We pay it on November 1st. Okay, so I'm gonna put in the liability first. So the vouchers payable, still very similar to accounts payable. 53. 1. Oops, I missed a number there. And here is the very tricky part. So we bought this truck.
Right.
Normally you say, oh, equipment or something like that. It's just an expenditure. Oops. So that truck, this is our checkbook. So that truck is just a payment out of our checkbook. We don't depreciate it. There's nothing in there.
Mhm.
It's just money going on. And you might say, well, these two aren't, this is different than this. Is there some kind of a, remember, these don't go on anything. These actually didn't hit.
Right.
So, no, you don't do anything on there. You put, if there's a big difference or something, you might be a little bit concerned. But if, at the end of the year, you're going to come in and hoping there'll be pluses and minuses. They usually don't.
Right.
But yeah, you don't do anything, but you do take it off at exactly what you put it on. However much money you put your hand on, that's what you take off.
Mhm.
So we put our hand on 53,000 for this thing. And down here, we paid for it. Paid the invoice. So we have vouchers payable. So this is a liability going up here. This is the liability going down. Now we're paying. Cash. So there's a bunch of wacky stuff that happens
Right.
when you buy a truck. It isn't like, accounts payable and equipment. You first put the encumbrances on the books for whatever the purchase order is, the purchase order amount. And again, the reason for doing that, to tell everybody you can't spend this.
Mhm.
Now, when we come down here, we take our hand off the books, and the reason it being, we're going to have this vouchers payable on the books. This is going to tell people, look, you can't spend this 53,000 because we need that to pay off this.
Mhm.
So this is actually a real account that would be, this would be on the financial statements. So these would all be not on the financial statements. But, you know, they, it isn't that they don't exist, they do exist, but they wouldn't be on the financial statements, they might be in the notes somewhere. And those are budget accounts. But these are what actually happened, these will be on the financial statements. But again, weird thing, it's just an expenditure. It's like paying the phone bill. And there, you know, you say, well, what about depreciation? There's no depreciation. Nothing on the books to depreciate. Okay.
But from government accounting, it would then go on as a capital asset.
Yes, for government wide, it would go on as a regular equipment and it'd be depreciated and all that.
Right.
That's yeah, and the balance sheet is actually fairly is pretty much the same for government wide. The only thing that's wacky is the income statement.
Mm-hmm.
The government wide. Look at government wide. Other than the sort of weird income statement, it's very similar to what you do in regular accounting. Mm-hmm. Okay, you want to try number 9 on your own?
Sure. Okay. All right. So on 12.9, you're putting through the purchase order for the 3 desks and the 1 chair. So it would be, let's see. So you'd be doing just encumbrances and encumbrances outstanding for the balance.
Yep.
Okay, let's see if I brought my calculator, and I did. Let's see. So that would be for $2,078.
Much faster.
Okay, so then the order was received for everything except the 1 desk. So then we would do on 12.15, we'd do encumbrances outstanding as the debit and encumbrances outstanding, and then do the encumbrances as the credit.
Okay, wait. So which one?
Sorry, down. So on 12.9, we do the encumbrances and the encumbrance as the debit and the encumbrances outstanding as the credit. Right. So that's 12.9 in the total of 2,078. Mm-hmm. And then scrolling down to 12.15, when we've received in 3 of the 4 items, we would reverse out $1,125 from the encumbrances outstanding.
Well,
right? No.
Well, you subtract out these for the encumbrance outstanding.
Right.
Whatever those come out to.
Is that not okay?
I'm not sure. So what we
953. Oh no, that is a different amount. Oh, okay. You're right. Nope, you're right. That's not the right amount. So it would be, let's see, 134 plus 2. So we would actually be doing it in the amount of 1158.
Correct.
Okay. Yes. Okay. That was my mistakes but then going into, so then if we've taken those off the encumbrances, so then we'd go into expenditures as the debit. And that would be for the 1,125. And then that would also be the vouchers payable, because we owe that to the when that increases our liability. Okay. So then on the 21st, when we pay for the three of the 4 items, we would vouchers payable would be the debit. And that would decrease our liability. And then our credit would be for cash. And those would be in the amount of the 1,125.
Yep.
And then we still have the encumbrance of whatever the balance is on the or for the 920 for the desk.
Exactly.
Okay. And the cash decreases our asset, the asset of cash. Okay.
Yeah, and notice that and that would simply decrease the amount in your checkbook. In normal accounting, this would be on the balance sheet. This would be just switching one asset for another.
Mm-hmm.
You know, your cash would go down, but your dust would go, or your equipment would go up.
Right.
So notice that in this type of accounting, it's not something. Your assets just go down, and this expenditure makes your fund balance go down. You know, it's a checkbook.
Mm-hmm.
So in regular accounting, this would be your assets would be exactly the same. You know, your equipment goes up, your cash goes down.
Mm-hmm.
But in this type of accounting, because we don't count it as an asset, it's something expenditure. It's kind of like expense the whole thing all at once. So there is no equipment on the books. So it's just on the asset side of it, it's just cash going down. And the fund balance goes down. Fund balance is okay, we have 1,125 less to spend. Our checkbook just went down. And whether we paid for equipment or a car or a building, it doesn't matter.
That makes sense.
Okay. All right. The libraries. City paid a total of $70,000 for the April payroll. The city collects state withholding taxes and federal withholding taxes for the employees during the month of April. Blah blah blah. These amounts were already included in the payroll. Okay, so they came out of the 70,000. So 70,000. Okay, so we paid on June 15th. Okay, so we pay our employees 70,000. What account do we use?
So that would that still be an expenditure then?
Yep.
Right.
They usually trips up people. I was being mean.
I had to think about it.
Yeah, everything goes out. Okay, now, so the state. Oops. Okay, now these are government agencies.
Right.
So we don't do accounts payable. We do two.
Right.
So let's do state first. So due to state, and you may say withholding taxes or something. I don't need to put that in now, but so due to state, 3,000. Federal, 16,000. And then the rest we just paid out to people in their paychecks. $51,000.
Yes. Okay.
Yeah, so these are, again, because they're government agency. If this was owed to somebody outside the government, so if you're
Like the health plan?
exactly good, I draw a blank. Yes, so if it was a health plan,
Mm-hmm.
this would be payable to accounts payable, whatever the health plan is. But if it's inside the government, it's due to, and if they owe us, it's due from. Okay, and they paid for it on 15th, so we would take off the state 2,000, and I would make those as separate entries. And quite honestly, on this one, you probably would have to, because you're not going to cut one check; you're going to have to cut two.
Right.
Checks. Yeah. And so they act just as accounts payable, but again, because they're in the government agencies.
Right. It's due to.
Yeah. Okay. Park district collected $50,000 cash from sales that were subject to state sales tax. On top of the March sales tax, another $5,000 in cash for state sales taxes were collected.
So in that, so in that case, they'd probably say that expenditures were 55,000.
Well, they collected this, so this would be the 50,000 is how much they collect 50,000 cash, but plus the 5,000, so 55,000 in cash was collected. And then, but the revenues would be 50,000.
Oh, okay. And the rest would be due to state.
Exactly.
Okay.
So they're going to keep 50,000 cash. Revenue will be collected. I did that not for profit. There's an account called customer capital. What did that mean? It's always
capital collected from.
Well, no, it's just money. It was actually what it was people who pledged money.
Oh, okay.
That was to be collected, but that account, it didn't tell you anything about it. And we were looking through it, and it took us a while to figure out what it actually was. And there's quite a bit of money in there. It wasn't like we could say, oh, it's trivial, $50,000. Okay. Next is yeah. So this would just be transferring it to the state. Take the liability off the books. so there's an increase in liability. So once you collect it, you owe it to the state,
Mhm.
pay it out. All right, the last page on here. Tax anticipation. So a tax anticipation note. These are, a lot of times when they levy taxes, the money doesn't come in for a while.
Mhm.
And they may need the money before it comes in. So they have this big asset of all this money, they're going to collect in the future, but they haven't collected anything yet. And so a lot of times they'll go to the bank and they get this tax anticipation note. And usually these have a fairly low interest rate because it's sure money, it's backed up by the, property taxes, which are, legally you must pay. So it's, they're usually fairly secure notes. And so they don't usually have to pay very much in interest on it. Okay, so they obtained 500,000. Okay, so cash will be going up.
Sure.
Okay. Now, if it's short term, and this note is, it was paid off in 4 months, November 1st. You probably put this in as notes payable. If this were a long term, it would be other financing source.
Okay.
Because it's short term, you probably just put it right in as a tax anticipation note payable. You just put in notes payable too.
Mhm.
So there's a liability going up. Okay. Okay, so cash goes up, tax anticipation note payable goes up. And again, if this was long term, it'd be other financing source, long term note or something like that.
Mhm.
Because this is going to get paid off at the same time, tax anticipation note payable is fine. Okay, now coming down here, so we pay it off. We're going to pay off the tax anticipation note liability. So that's going to go down, but we have to pay some interest here. So let's see. $100,000 times what we had for 4 months. So 7,
Mm.
yeah, 4 months. And then it would be 3% of that. Just 5,000.
Yeah, should be.
Right, so 5,000. Okay, so we take the note off the book. That 5,000, what are you gonna call it?
Just interest payable.
Nope.
Voucher payable for interest.
Starts with an E.
Oh, expenditure for
It's expenditure.
interest.
Yeah, you put for interest in there too, but it's just,
Yeah.
you know, and they paid up cash. At 5,500. Questions on that?
No, that makes sense.
Well, I think what I'm gonna do, I think next week is our last regular class, isn't it?
Next week is the 2nd.
Yeah, I think we'll go through the 9th, I think. So that one last class, now we'll put that in for the exam.
Oh.
So I think what I'm gonna do, I'm gonna send you out the practice exam.
Okay.
And let me. Have the practice exam. Where- This is 2020. Yeah, I'll change it to 2021. So it's not confusing. Move quickly. Okay. All right, I'm gonna go ahead and send that out to you. And actually, I'll send it right now. Then why don't we go look at it?
Perfect.
And do you want it also in the PDF form?
No.
Okay.
Not for something I'm going to do in Excel, you know?
Yeah.
It always cuts it off weird and, you know.
Yeah. Did it come through yet or no?
Let's see. Hold on. So my computer's thinking.
It didn't come through on mine, so. Save it again. Blackboard is so weird sometimes with an email.
Yeah.
I've actually had sent out stuff and we didn't get it. We didn't get it.
Oh, wait.
Eventually,
There we go. Just got it.
yeah, okay. I actually had a delay of like 16 hours. Usually it's only a few minutes, and sometimes it's been like a couple hours, but when it was 16 hours, so it sent it out at like 3 in the morning. Here, do something on the 3 in the morning. What are you talking about? Okay, so I think I got this from the CPA simulation. So these are like the list of things that happen. Left. And you make the journal entries on the right. So this is the budget.
Mhm.
So covered purchase order, we said the encumbrances. Mine just came through. This bond issued for cash, we didn't do this one. This would be other financing sources, bonds.
Mhm.
You know, normally you'd think of that as a liability, but in our wacky fund accounting world, it's just, hey, money came in.
Mhm.
But so H will be other financing sources, bond. If it was to be paid, if these were to be paid off in the same year, which it doesn't say on here, if they were to be paid off in the same year, you would just put it as bonds payable. But if these are more than 1 year, which I'm assuming they are, and the other financing sources, and those do not go on the balance sheet as a liability. Only short-term liabilities are on the balance sheet. So for wacky governmental accounting, that would not show up. This would actually show up as a revenue, basically, money coming in, which kind of explains why we have such a problem with, you know.
Yeah.
Issue debt, yeah, that's a revenue. How about that? Okay, so here's kind of the way this is laid out. I know it's kind of a wacky format, but anyway, so there's journal entries are to the side here.
Mhm.
And so you make journal entries for these. And then over here, and this is something you'll see on the CPA exam more, they'll ask you, what was the difference? What were the differences between actual? What were the private taxes encumbrances outstanding at year end? These are all kinds of things that they might ask you on the, as far as what balance of it. And these would be sort of like, they probably wouldn't be this extensive. They'd probably be more like a multiple choice problem. They give you some of the accounts and then say what would be the difference between the actual and estimated. The big one there being estimated expenditures and actual expenditures. The estimated expenditures are the appropriations.
Okay.
And I think I told you that that they're very big on using that that name. So when estimated expenditures, make sure you use the name appropriations on the journal entry. Name appropriations for regular businesses too. Usually they call the long-term planning stuff appropriations for businesses. And by the way, in government, they talk about the being on the appropriation committee in Congress and all that kind of stuff.
Right.
Well, those are the expenditures. So that's it's a very powerful job.
Yeah.
Because that's like basically all the money that gets sent out to the states and stuff goes through that committee. So if you're a state, you really want to have people on that committee. So,
right.
But yeah, so appropriations. Okay, now if you just do the journal entries, that if you want to try these other ones, go ahead and and we'll go over and see what these,
Right.
but yeah, so, what do we got for next week? And
Okay.
And so next week we're going to go over this, and I think I'm going to go over the financial statements for the government-wide.
Mm-hmm.
The government-wide financial statements, especially the income statement like thing that they have, that of this, the last few times I did the CPA review, those seem to be on there quite a bit. So
Okay.
we're going to do
Yeah, that's good to know.
So the fund accounting is the wacky journal entry one.
Mm-hmm.
Government-wide is the wacky income statement one. So we're going to do the wacky ones.
Mm-hmm.
Like we do. And the other ones, you know, are normal ones.
Right, right.
So, all right. Any questions?
No, I guess I'll see you next week then.
Okay, very good. All right.
Great.
See you, John.
Bye-bye.